Good morning, everyone. Thank you so much for joining us for today's free webinar, Coming to America, Part 2, Accessing U.S. Capital, with Bob Mollen from Freed Frank, Joshua Siegel from Rubicon Venture Capital, and Glenn McCrae from Early Growth Financial Services. My name's Erica Malsberg, and I'm the CMO for Early Growth Financial Services, and I'll be your moderator today. This presentation should run about 40 minutes. If you have questions as we go along, please feel free to enter them in the question field, or you can also tweet them to us at earlygrowthfs with the hashtag AccessUSCapital. Don't just raise your hand, just go ahead and jump right in with your questions and we'll answer them as they come, or we might wait till the Q&A at the end. If we do run out of time, we'll be sure to follow up so that all your questions have been answered, and you'll be receiving an email tomorrow with a link to the deck and today's recording. We have 3 panelists on the line today we're very pleased to introduce. First of all, we have with us Bob Mollen of Freed Frank. Bob is a U.S. qualified corporate partner who's been based in Freed Frank's London office since 1991. He co-leads the tech practice at Freed Frank. Bob focuses his practice on international corporate and securities matters and legal crisis management. He has extensive experience with securities offerings and mergers and acquisitions in a wide variety of industries, with a particular focus on tech companies. Bob regularly advises early-stage companies in connection with their establishment and expansion of U.S. operations. We also have with us, I just heard him join the call, we have Joshua Siegel of Rubicon. As general partner in New York, Joshua oversees the day-to-day activities and operations of Rubicon, including evaluating early-stage tech companies seeking funding, assisting current portfolio companies with development and interaction with our angels, attracting LP capital, and developing their network. Joshua began his career as a New York investment banker and rose to the director of market intelligence at Citicorp Debt Capital Markets, and subsequently became manager of Eastern European banking systems at Citibank, and later was with the Overseas Private Investment Corp, a division of the U.S. government that provides investment options internationally. Following business school at Georgetown, he worked with multiple startups and tech companies during .com 1.0 in New York City, and then established a successful real estate business, focusing on historic real estate development through his firm, Fantasia Partners. In 2007, after selling the bulk of his real estate holdings, close to the top of the market, he became an active angel investor, investing in numerous companies and holding executive-level positions, including CEO of Professional Connection Resources, an enterprise-level marketing system for the legal community, and board advisor in New York with interests in tech, real estate, digital media, consumer products, and luxury lifestyle brands. Joshua became an advisor, investor, and board member of the Founders Club, an innovative equity exchange and liquidity platform for entrepreneurs. Joshua also co-founded Georgetown Angels, which became Rubicon Venture Capital. He received his BA degree from Boston University in Economics and Business Administration, and his MBA from Georgetown University's McDonough School of Business in Finance and Entrepreneurship in 2000. He also holds a degree in gastronomy from the Institute of Culinary Education in New York. Joshua was born and raised in New York City, attended Horace Mann, and lives with his wife, son, and daughter in New York City. So welcome to you, Josh, as well. And lastly, lastly, we have with us Glenn McCrae, Chief Strategy Officer at Early Growth Financial Services. Glenn's an experienced CPA with extensive early-stage company experience. His experience with smaller growth companies has helped him develop a deep understanding of how sales, strategy, financing, operations, and accounting each play a critical role in the successful growth of a young firm. Glenn's expertise includes capital raising from seed stage to IPO, strategic analysis of business opportunities, business development, and financial analysis. And welcome to you, Glenn.
Thank you, Erica.
Sure, and I'm so sorry, Bob, I did not welcome you. So welcome to you, Bob. And before we dig into the actual core of this presentation, can you start and just say a few words about Freed Frank for us, Bob?
Well, Freed Frank is a global law firm with its largest office in New York. And we basically do primarily a large financial services industry and M&A large corporate business. But on the tech side, our focus has really been on helping non-U.S. companies set up in the U.S. and do so cost effectively. We're finding that companies are needing to go to the U.S. at a much earlier stage than they might have historically, both for operational reasons and also for investment reasons. And so it's important to be able to do that on a cost-effective basis, and working out of our London office and covering Europe in particular, but also elsewhere outside of the U.S., that's what we do.
Thanks so much. And Joshua, can you say a few words about Rubicon Venture Capital?
Sure. Rubicon Venture Capital is a atypical venture capital firm. We do have dedicated capital, and we invest in later stage seed, Series A, and Series B early stage technology companies that are focused on the software internet space. We are atypical in that we don't take board seats, we don't lead rounds, but we do provide significant support for our portfolio companies through our venture partners and dedicated LPs to the fund. We principally concentrate on the U.S. market, but we also invest widely in Europe, in London, Stockholm, Germany, Italy, and we have LPs as far and wide as Japan, China, Russia, all throughout Europe, and also throughout the United States. So we have a full-time office here in New York, which I run, and we have a full-time office in San Francisco and in Los Altos, which is in Silicon Valley. So we have a pretty wide breadth. We have invested with over 60 other venture capital firms throughout the ecosystem, and we're pretty active.
Great. Thanks so much, Joshua. And lastly, Glenn, can you just tell the audience a little bit about Early Growth Financial Services?
Certainly. We're an outsourced financial services firm. So what we do is anything other than operation and sales we can help you with. So when you come to the U.S., there's all sorts of nuances that you have to get your head around in terms of how to run a business in the United States. And we can help you with that, help you navigate that so you don't really have to worry about it. You don't have to put too much mind share on it. Our organization is national in scope. We do have an office in New York. Our headquarters is here in Silicon Valley. We have probably about 350 clients. Usually they're at early stage, so they may have just gotten to the point where they're looking for outside capital. They may be having raised their first round all the way through the C round. We're very networked within the ecosystem. That's a word you'll hear a lot when you come to the U.S. The startup ecosystem is comprised of all sorts of service providers as well as investors like venture capitalists. So, Fried Frank, Early Growth Financial Services, people on the human relations side, bankers, things like that. We're very tied into that ecosystem. So we have a team of CFOs as well as what we call senior accountants who are a little bit lower level, and we can help at the earliest stage and grow with you as you grow.
Great. Thanks so much, Glenn. Okay, that said, we have a lot to cover here, so I'm going to just let you guys jump right in.
Okay, so this is Glenn, and basically what we're giving you here is an overview about what we're trying to cover in this presentation. Whether you've made the decision to come to the United States or you're just exploring it, we're going to assume that you're on a fast growth path and that you need to access capital as well as markets beyond where you're currently located. Maybe you have some friends who have made the jump over to the U.S. and you've seen it work for them, and you're exploring, what does that mean for you, and how are you going to pull that off, and what do you have to get your head around. So, clearly, when you come over here, you're going to want to have good legal representation to make sure you've got a structure for your business, and Bob's going to address that. And you're going to want to meet with investors. How do you pull that off? That's one of the things that Joshua and I are going to talk a little bit about. Once you get that meeting, what is it that people are going to be looking for? Do you have some content that you can show people to help line up a meeting for you? And then just in terms of how the venture capital investment landscape works here, with the different rounds that people look to invest in, a firm like Rubicon is an early stage firm. And then there are other firms that are more established with larger dollars that invest in later stages. So we're going to explain that a little bit. We're going to talk about how you would actually go into a meeting like that and what is called a pitch deck. If you're not familiar with that, we'll touch on that. We're going to talk about what kind of financial information investors are going to want to see. And we're going to talk about the legal considerations about structuring your business. And at this point, we're going to let Josh take it over.
So why is the U.S. the place to be? Well, it's not necessarily the only place to be, but for the purposes of this discussion, we're going to focus on it. The ecosystem in the U.S. from the point of view of venture capital and startup is very, very solid. people know what's going on. A lot of people are connected, even from city to city and state to state. So if you're going into the New York ecosystem, the San Francisco ecosystem, the LA ecosystem, the Texas ecosystem, really Austin, or even in Miami, the ecosystems are fairly developed. New York and San Francisco are obviously the most developed, and then you'll have secondary cities like Boston, LA, Austin, DC, and things like that. But once you get into a particular area, you can rapidly find the right people that you need to talk to. There's a very good system of communication. There's a very good system of everyone who knows each other, the attorneys, the finance people, the angels, the VCs, even the press. So it's very easy to get involved and see what's going on. It's also very easy to find out what's going on with other startups. There are lots of newsletters out there, lots of reporting. A lot of stuff is very public. You, of course, do have the stealth startups and stealth financings and things like that. But it's a very, very evolved ecosystem. So people can find stuff, you can find them, and it's good. Exit values are also very high in the U.S. because we have the most developed and efficient capital market system. So as companies go public, they look to acquire other companies rather than build stuff in-house. They want to get to their customers quickly and efficiently. They want to add quality tech talent and quality products to their existing base already. And that leads to the fact that things are expensive. So rather than in Europe or even Israel or Asia, the U.S. pays more for this stuff simply because capital is cheap. It's very easy to access the capital markets. It's very inexpensive to access it, and therefore values are much, much higher. So if you're looking to exit at some point, you do really want to have some sort of presence in the U.S. because you will get a much higher multiple for your business than anywhere else. So what's going to make you more attractive to a VC, especially on the U.S. side of things, to get funding? Well, of course, we love to see either a U.S. presence already or the plan to enter the U.S. market with your product or service. That's really important. So you don't necessarily have to be here quite yet, but you do have to be set up to launch into the market. It's also a good thing that if you already have backing from a U.S.-based VC that has invested in you overseas, or you have backing from a known angel or VC in your home market. So in London, these would be things like Excel and Index Ventures. So if you have backing from them or even people associated with them, that's good. We do take notice of that. And the reason why that's important is because if another VC has already done a lot of the work and evaluated you, then we can take you much more seriously. That's not to say that you have to have that. It's just a good thing to have it. The other thing is runway. We want to be sure that if we're investing in you, you have a good 12 to 18-month runway, which is the amount of capital that you'll need for 12 to 18 months of operations, because in case anything goes wrong, and 99 times out of 100 something goes wrong, it's really important that you have enough time to fix it. And VCs like us and here in the States will help you. The capital is very cheap from a VC. You want quality VCs that have connections, that have the ability to help you accelerate once you land here. So what do we like to see? Well, we do like to see you have a really good full team. It doesn't have to be 100%, but if your product or service relies on tech or sales or something specific, you need to have the guy in place that knows how to do that. It's okay if you're eventually going to hire someone else to augment that team, but we really do like to see a pretty good-sized full team in place before you're coming over here. We recognize that you may have to hire people. That's okay. We get it. Do you have to have a minimum viable product? Absolutely. Any VCs are going to require that you really have a minimum viable product if you're a first-time entrepreneur or if this is the first time you're dealing with them. If you've done it before and you sort of created a beta or prototype, that's one possibility, but generally speaking, you really have to have a minimum viable product and be ready to execute on that product initially. Have some beta testers, get things going. Depending on the round that you're at, if you're later stage seed, you're still trying to work some things out, that's okay. You still need to be able to execute to a certain degree, but nobody is ever looking for a product that's 100% done, because the reality is your products are never 100% done. You're always working on it. So that's okay. But if you're at a Series A or Series B, you really need to be able to scale right away and execute on your product. The other thing is looking at the market. When we look at companies, we like to see a full team, we like to see the product, and we like to see what market they're attacking. Do you really understand your market? Is your market big enough? Does it really make sense? And are we the right VC to help you, or any other VC for that matter? So you really want to make sure that what you're doing is appropriate. Do you have US-based service providers? These are things anywhere from hosting to legal, to accountants, to venture capital, to payroll. All of these services are available. They're easy to find. You simply ask the right people that you know. Starting with your lawyer or accountant is a great thing, but you do need these people because you do want to be set up to take in capital correctly, to pay your employees correctly, to process invoices and bills correctly, and not have to worry about this stuff. The legal, accounting, and back office stuff is not things that you should really be worried about concentrating on. You need to concentrate on the execution of your business. Everything else can be handled outsourced for the most part.
And Joshua, before we move on, we do have a question here from the audience. In regards to the full team, Edward wants to know if it's okay to have your full team based in your home country, or if you prefer to see some team members in the United States on the ground.
Generally speaking, you definitely want to have some team members based on the ground, because if you're a product that you're selling, you have to have salespeople here. So you don't have to have your CEO based here, but you definitely have to have a sales team. The caveat to that is, depending on how much money you take, the CEO is definitely going to have to spend a considerable amount of time here, especially if they're penetrating the U.S. market. So it's not a make or break thing, but you definitely want to be able to spend time with the guys that are giving you the money and your most important clients.
Great, thank you.
Hey, Joshua, I have a question for you. This is Glenn. The concept of traction is really important when you talk to investors. And it seems like there's a disparity between looking at the European market, where later stage investors really are looking for profits. They're looking for a return on their investment in the terms of a profitable organization. But when you get to the U.S., it seems like there are a different view of what gets investors excited. Could you speak to that just quickly?
Absolutely. So there are different schools of thought depending on what your product or service is. If your product really is meant to generate large revenue early on, then yes, we do expect you to have revenue for that product. You need to figure out if people are going to pay for it. But more importantly, at this stage, we're looking for scale. We're looking for you and your team to be able to execute on your product, get a lot of people to use it, and then be willing to pay for it later. You don't necessarily have to charge the full amount or even any amount right at the start to get people to accept it. That's something that will happen later as well, but you have to be sure that you have enough runway in order to do that such that you become valuable. Companies like Box and Dropbox, they had no revenue models when they started. So, now they're obviously generating substantial amounts of revenue, but they still lose money, and they really didn't have much of a revenue model. So it really is about scale and making people want to use your product such that when you turn the switch to charge them, they're really excited to pay for it because they can't do without it. So it's okay not to be making money yet, but you have to have engagement. People have to be using your product. Cool. So we're going to move on to the next slide, which is meeting investors, targeting people, networking, things like that. All you need is one particular in to start the networking process, and usually that can be even an introduction from your home country, because depending on the VC, we'll know the people that are in your home country, or we'll know the lawyer, or the lawyer will know someone, or the accounting will know someone, or a fellow entrepreneur will know someone. So what you need to do on your side is really evaluate who are the people that I want to meet that are in the United States that are interested in my product, in ad tech, in financial tech, in ed tech, in travel technology, whatever it is, you can find them. There are lots of resources like Crunchbase and AngelList, AlleyWatch, all different kinds of things where you can find the right people. LinkedIn is another great resource. So you want to be able to get an initial introduction and then network your way to the right person. If you have a quality startup and you are a quality individual and you have a quality team, people will make introductions really just as a professional courtesy. But you got to be careful how many you ask for and who you ask for. You can't ask for an introduction right away to Peter Thiel or Bill Gates or something like that when someone doesn't know you. So you do have to be courteous in how you ask for things and things like that. Warm introductions are the most important for VCs. Typically, if we get a deck from someone we've never heard of, we don't really give it as much of a serious look as if we really get a warm introduction from either one of our LPs or one of our portfolio companies or a fellow VC. We take all those introductions very seriously. We will look at the deck and we will take a meeting almost regardless. Even if we're not interested in investing in the company, we will always take a meeting as a professional person. The other thing is to use your attorneys and use your accounting firms. They all have great professional networks and resources, and they can reach out. In the UK, especially throughout the rest of Europe, lawyers are not really utilized until the last minute. But I urge all of you, you need an attorney that really understands venture in the US, because when a VC is going to invest in you, that's one of the first questions they're going to ask. And when they're sitting across from you and your attorney, they want to make sure that it's going to go smoothly and that your attorney has explained things to you and you understand everything. So that's really, really important to do that. The other thing is to start early. You should all be building your networks now. You never know when you're going to meet someone, want to talk to them, even if it's just to say hi or whatever. That's really important because 3, 6 months, a year later, when you come back around, they're going to remember you. It's almost just like dating. You meet a girl, you're not going to ask her out the first time, but a few months later you might be like, now I need to talk to her again. So very important to build that groundwork. So the fundraising game plan. What are you looking for? How much? How's this all going about? Most of the companies that are going to come to the U.S. have already raised some form of seed stage capital and have been going for a year or two. It really depends. You have to determine now how much do you need to raise in either a later stage seed round or Series A or Series B. You might not necessarily know, but you should. A good gauge is you want to raise at least enough capital for 12 or 18 months of operation. Any more than that, you probably don't really need, and you might be giving up too much equity in this round to take a larger sum of money. You may feel like, well, I'm going to raise once and I don't need to raise again. That's not a good way of looking at things because you always want to leave the door open for raising more money later, and you don't want to give up too much equity at the moment. You also want to have a clear idea of what you're going to use the money for. People aren't just going to fork over money for you to execute. They want to know, are you doing marketing? Are you hiring? Are you doing tech? What is going on with that capital? You really do have to have a good idea. Don't worry about creating financial spreadsheets for 5 years. Nothing on that spreadsheet is going to be accurate, after day 2, really. Your expenses might be, but that's going to be about it. Lots of things change. You really just maybe have a 2 or 3 year idea. Keep it fairly simple. You should know what you're doing, but when you're presenting stuff for the first time, keep it fairly simple. Terms, how much you're going to raise, at what discount rate, and things like that. All that is fairly negotiable, but you do want to have an idea when you initially present to an investor of what you're looking for and what you're thinking. And that's a way for an investor to gauge, are you realistic? Do you understand this process? Do you know what's going on? So, it's okay to say those things out loud first to investors. They're really just trying to gauge and see what's going on. But your lead investor is going to come back to you with a term sheet and really decide, give you the opportunity to decide, are you going to take money at this and this amount? Okay. Then it's also with that the type of capital. Is it a convertible debt note? Is it preferred equity? Is it common? In Europe, a lot of people raise money via common stock. It's very prevalent in London. It's very prevalent in Stockholm. It is not done here by and large. VC investors and even most professional angels will not invest in common stock of your company. It's just not done. It doesn't give the same degree of protection or risk versus reward as something else. So don't think that you can come here and sort of lay out a common stock scheme and you're going to get capital. It won't happen. So you can do either convertible debt or preferred equity. That is actually really good for both you and the investors because of how it aligns both sides. Preferred equity is good because it's a very simple class of shares and has certain rights and privileges, but it all votes together as a class. Convertible note is also good because you can consistently raise money and have multiple closings as you go. So maybe you raise your first 250, and then 3 months later you raise another 250, and 3 months later you raise another 250. So you can do that with convertible debt. With preferred equity, it's a little harder, and with common, you just don't do it. Finding the types of financings, convertible debt, as I said, is mostly a angel type of situation. VCs do it, but it's mostly angels. Preferred equity is really something that the VCs do. If you go to an angel group and they are demanding preferred equity, depending on how much they're putting in, you might want to rethink that. You never want to price your round too early, too soon. It's very expensive. It can lead to all kinds of craziness. So you really want to be sure to price a preferred round at the appropriate time. How much should you raise? We touched on this. 18 to 12 months of capital. You really don't want much more than that. Your valuation is going to be based really on your investors. They're going to come to the table with a term sheet and decide what you're really worth. You can manage that process by, showing comparables in the market, what you've already done, how far you've gotten, how much revenue you're expecting now, how much you've already generated, things like that. You also need to have an idea about dilution on a round-by-round basis. Typical dilutions are anywhere between 20 and 25% per round. As you get to be a more mature company later and later, that dilution goes down. Don't be worried about dilutions. You have to remember that you're using other people's money to fund your dream, and you have to pay the price for that. There is a way to get that back, though, with bonuses and option grants and things like that, which are all things that you need to talk to your accountant and your lawyer with, because even though you're going to get diluted 20 or 25%, you may end up getting back 5 to 8% of that in the long haul. So don't worry about that.
And Josh, a quick question for you. The concept of valuation is one that founders spend a lot of time agonizing over. Are they selling it too cheap or too rich? In your opinion, when a founder approaches a VC at an A stage, how strongly should they hold on to the concept of valuation, and how much of that is really a negotiation with the lead investor?
So generally speaking, in an A round, you're probably already worth somewhere between $10 and $15 million, give or take, and you want to be raising between $3 and $5 million. So that's a good chunk of money. The difference between a $15 million valuation and a 14 or 13 is fairly negligible on the VC side of things. You're not going to get a lot of push in one way or the other. You need to be realistic, though. If there's a large option pool, you'll need to include that. And the reality is the more money you take, the more you have to be realistic on lowering your valuation somewhat, because it is a lot of money that somebody is putting into you. Holding firm is not necessarily the best way to do things, because a VC can just turn around and be like, all right, we really don't want to do it at 15. It's got to be at 13, otherwise we're going to walk away and invest our money into something else. That's rare. It's really rare that that happens at that stage. unless there's a widely disparate viewpoint on valuation. At the end of the day, we as VCs want to be in business with the entrepreneur or not, and vice versa. And if you don't get a good feeling either way, and you're having a problem already, you don't want to continue to do business with that particular person, VC, team, or whatever. So the idea is be open. Don't back yourself into a corner and say, it's got to be 15 or nothing, or we're going to walk away. Because if you're looking for capital, you need it, you might not have another alternative. Or, more importantly, you really don't want to waste the time for another alternative. All of this money can be earned back later.
Okay, so I'm going to take over at this point, and we're going to talk a little bit about when you're coming over here to the States and how you should be thinking about going about raising capital. We touched on milestones earlier. One would think that you've already achieved some very important milestones in your business in your home country. So you may have a beta of the technology out there. You may have secured your first enterprise customer. If you're building a marketplace, you may have built both sides of the market so that you actually have transactions flowing across your platform. Things like that are very important milestones. And so you want to come into this fundraising process when you come to the United States with a mindset of, okay, I'm getting involved in a new process. It's just as important to my company, if not more so, than the core business that's going on here, because I need to try and get capital for me to achieve the real potential for our business. So think about it as a business development process. Think about the time frame. So if you're going to be running out of cash in 9 months, it's okay to not be anxiously trying to raise capital now. But if you're raising if you're going to run out of capital in 3 months, well, you really didn't get started early enough, because it's going to take some time for these relationships to develop. And a lot of firms want to meet people and get to know them over a period of time before they invest. It's not like going out and closing a sale with a customer where you can just get a meeting lined up and go for the close. It's a much more evolved process than that. So we're going to talk about how you build your value proposition, and as we've talked before, relying on the ecosystem for investor introductions. So, what we're talking about here is kind of how do you get across to this audience, these potential investors. And it's not monolithic. Everybody, is different. Every firm has their own way of looking at the investment landscape. But there is a format that's important for you to just kind of think about and try and understand, so that you can take your current way of approaching investors, that may have worked for you really well in Europe, and think about maybe tweaking it a little bit and changing it a little bit so that it's going to be a format that VCs are comfortable with. So I think that from my perspective, it's almost like how you bait a hook. If you're going after largemouth bass, you may have to have a certain kind of fly or a certain kind of lure. If you just put a worm on that hook, it's not going to attract your prey, the fish. And so your prey is the venture capitalist, and they have a way of looking at the investor landscape that they're comfortable with. They have an expectation that when good prospects, good investment prospects come to them, they're going to look and feel a certain way. And even though you're European, there's no reason why the format that works for folks here in the U.S. can't work for you as well. And that's what we're going to talk a little bit about. We're going to talk about your elevator pitch, and I assume everybody understands what that is, which is in 30 seconds, what's exciting about your business. The next is an executive summary, which is a 1- or 2-page format that really gets to the heart of what your business is all about, both from a legal structure standpoint, investment standpoint, as well as a business model standpoint. And then the most illustrative tool is the pitch deck, and we're just going to kind of talk about that a little bit. So I think that the thing I'd like to present here, there's a great book that we've got referenced on this deck called Inside Silicon Valley, How the Deals Get Done, by a local venture capitalist here in Silicon Valley. And these slides are taken from that book. There are other good books on this topic. Art of the Start by Guy Kawasaki is very well known within the Valley. And all we really want to do here is we're not going to train you on how to build a pitch deck. What we want to convey to you is that the format is very important, because when we say introduction, when Josh says warm introduction, what he really means is that you're going to have an advisor or a service provider who has contacts, who's going to open up those contacts to you. But what are they going to do? They're not going to set up an hour-long meeting with a venture capitalist for you. What they're going to do is buy you 5 minutes of time. 5 minutes, maybe 7, maybe 10, but 5 minutes, and it's not going to be a personal face-to-face. It's not going to be a discussion. What it's going to be is you conveying written material to that venture capitalist, and then they will make a decision based on that material that they're reviewing whether or not they want to take a meeting with you or not. We've got relationships with about 180 venture capitalists, and that's how we deal with all of them. We get an executive summary and a pitch deck. We send it over to the venture capitalist, and we ask that venture capitalist if they'd like an introduction to the company. So you really don't want to have more than 15 slides. Sometimes 18 can be okay. I mean, if you can get it down to 12 slides in your pitch deck, that's really good. Basically what you're trying to do is convey why you're excited about your business, but you're putting it in a structure that helps somebody who's analyzing it, some third party who doesn't, have a seat at the table with you and doesn't really understand what your business is all about. Why is it that they're going to be excited about taking a meeting with you and potentially investing with you? And each of these slides touches on something that's really important from a venture capitalist perspective. We're just going to talk about these slides really quickly. So your mission and vision, right? What are you all about? Right? They can see really quickly, is this an area that I like to invest in, or is this not for me? And hopefully it's to the point, it's quick, it conveys, hey, this is what we're all about in one slide. Next, the problem. The problem is really important because venture capitalists want to see solutions for big problems. If it's not a big problem, then they're not going to think that you have large potential. So obviously you're solving a problem, or you're providing a solution to people that enables them to do something amazing, or to solve a real pain point for them. That's what that slide's there for. Next is kind of what's the market opportunity. If I was to look at the current landscape that deals with this problem or provides this solution to people, what's it look like right now? And what's the potential for my business? Market strategy. How are you going to take advantage of that opportunity? How are you going to capitalize on it? To some extent, what have you done today? What are your thoughts for tomorrow? How are you going to get there? The technology. I've seen people who come to the United States get a little bogged down in a slide like this, because really when you're all about, if you're a tech company, this is what's all exciting, right? This is what you've built. This is your baby. This is, you can't describe this in one slide, right? Well, this is where the hard work comes in creating a pitch deck, is taking something that's got a lot of content, a lot of moving parts, and boil it down into one, maybe 2 slides that really help people understand exactly what it's all about. And obviously it's going to be high level. That's fine. What you're trying to do is let people know how developed your technology is, how far along it is, what's special about it. Competition, we really want to really encourage you to think it through. You may not think you have competition. If a venture capitalist is really focused in this segment, in this market, they're going to know who else has come along. They don't like to invest in Me Too companies, so this is a chance for you to differentiate yourself and help somebody kind of say, hey, you might know about this company, but this is why we're different than they are. It really kind of validates that you know the market, and VCs love to invest in people who have a deep understanding of a market. The financials, I'm an accountant. My firm does this sort of thing. I think all you really want to do here is convey that we have a chance to be really successful and to be a significant player down the road. So I don't think that people are expecting you to have a lot of deep content on the financial slide. I do think it's important that you put it in there so that people understand that you do have financial acumen and you know how to translate market opportunities into dollars and cents. And so for that reason, it's got some importance. funding requirements and milestones, I hope that's pretty obvious. How much money are you looking to raise? And if you got that money, what would it enable you to do? The U.S. is very big on milestone funding. So if you can show that you've achieved a significant improvement in your business model, however you look at that, then that's going to accrete a higher value to the company when you go up and raise your next round. And obviously, you don't want to have down rounds where the value has gone lower or flat. You want to have up rounds. So the more exciting the milestone is that you can achieve with this funds that you're trying to solicit, the better it's going to be. And then clearly the management team is really important because people want to do business with people that they know, they trust, they like, they have confidence in. That's really what this is about, is trying to convey that the investor should be confident that you have a winning team and that you've got a great opportunity for them to get involved in. Actually, I think on this, this is a little bit down the road from, this is once you've got that meeting lined up. And I think that my guess is that everybody here has raised some capital before, so you kind of know what it takes to seal the deal with a potential investor. This is once you've got your meeting lined up. If you've got a meeting lined up, personally, I consider that a level of success. And Joshua might want to speak to that as well, because you're going to get valuable feedback if you actually get an opportunity to present to an investor. They're going to look at the opportunity different than you do. They're going to give you some insights that might help you with the next pitch presentation you're going to make. So it's really good to get that meeting. And when you get that meeting, obviously you're going to want to have, whoever the other real key player on your team is, if it's, your CTO or your CMO or whoever it is, have whoever the real critical members of the team be there with you and share the stage with them. One person can lead, but it's really good to show that you've got a team concept going on and everybody's fully invested in what's going on. Clearly you're talking about the company opportunity. Don't get bogged down into the technology of it. Charts and graphs are always a great thing. Visualization's always a great idea. Know your numbers well. Understand that you need to have financial acumen, but don't expect that you're going to have to play it all out on the board in that meeting. These other items are pretty intuitive, I think. This is a business meeting. You're going to try and convey important information as quickly as you can and as efficiently as you can.
Glenn, I would say that this is an area where we find, at least in the London market, that there's probably underinvestment. In other words, the U.S. startups are very good at talking the talk. There is sometimes a tendency for European companies to both maybe inadequately prepare in this area and also understate what they're able to deliver, and so it's important to spend time in really getting your pitch right.
Great, thanks. And we have a question here from Sarah. She's just wondering, in terms of pitching to investors, how many investors are you really targeting to pitch to? Is it a numbers game here?
So this is Joshua. I'll take that. It can be a numbers game depending on what stage you're at. If you're at the seed or later stage seed stage where you're still going for angel investors and you're trying to raise like $1 million, you might have to go to 15, 20, 25 people. I mean, it really depends. If it's a Series A type thing, you should have identified probably your 6 to 8 venture capital firms that you really want to lead and or participate in the round and really be pitching them. Once you pitch a VC and they really like it and they're in, even if they're not going to do the whole round, which is rare that they do, they will send you to other VCs that they typically co-invest with, and you don't have to get the meeting yourself. They'll get that meeting for you, send it over, and be like, look, I really want you to meet her, we're going to invest, and we want you to come along for the ride. So it's a numbers game to start, but it really depends on you, the entrepreneur, to figure out which VCs you really want to hit, and for that matter, which lead angels that you want to hit and/or angel groups. So it really depends.
Great, thanks.
I think we're going to go really quickly on this slide because I'd like to give Bob enough time to talk. He's got some deep content that's going to be very valuable to you folks. I'm assuming that you have financial models that you've used to raise capital in the past that you're using to manage your business. So it's important for your actual financial information to kind of map your projections so that you can track things going forward. Because it's important to show financial discipline in your business. So as you're building your financials, you've got your model, you've got your revenue projections. Everything usually starts with revenue if you're at that revenue stage. Think about how much money it's going to take when you look at your spending plan, and generally most of the spend is going to be on the people side of things, whether it's contractors or employees. And think about what milestones do we need to achieve while we're spending this money, such that we now have a better valuation for our company, our business is more established, and we can go out and raise more capital. Keep in mind you're going to want to try and go through that capital raising process about 6 months prior to actually needing the funds.
Okay, well, thanks, Glenn. This is Bob. In terms of kind of issues that we find that non-U.S. companies face in looking for U.S. investment at the beginning, the first question we frequently get is, do we need to have a Delaware holding company? Do we have to flip over into a Delaware topco in order to get U.S. investment? If you'd asked this question 5 years ago even, the answer would probably have been yes in most cases. I think that what we've seen is there's been a shift in thinking in that connection. First of all, investors, more sophisticated investors, especially on the east coast of the U.S., have become more comfortable with some kinds of non-U.S. holding companies, and particularly U.K. and Irish holding companies, where there are significant tax advantages. Those advantages are twofold. One is the corporate tax rate in the United States, federal and state, is about 40%. In the UK, it's about 20%. In Ireland, it's about 12%. So there is some benefit even going along to having your non-U.S. operations not under a Delaware holding company. The other area of benefit that we've seen is on exits. Many U.S. technology companies, which have been critical in terms of acquiring emerging companies, actually have a lot of trapped cash outside of the United States. And by trapped cash, I mean money which, if they bring back to the U.S., are going to have to incur a U.S. tax charge. So for them actually to acquire a non-U.S. business, maybe one which has developed a very substantial U.S. business through an operating subsidiary, may actually be a very tax-efficient way for them to use that cash, and therefore they may in fact be prepared to pay a higher valuation for a non-U.S. holding company than for a U.S. holding company. On the other hand, other jurisdictions are more problematic or at least exotic, and the question is whether investors are going to be prepared to think about what it means to be a shareholder in an Indian company or an Estonian company or a Swedish company, and those are all questions which I've had over the course of the past week.
Hey Bob, just a quick question. Do you have any sense, or maybe Joshua does, about the number of VC early stage investors that are precluded from investing outside North America or outside the U.S. because of their organizational documents?
I'll let Josh answer that as well. My sense is that that was more of a problem 5 to 10 years ago than it is now. But it is true that we still find that there are some funds, particularly smaller funds, where there may be those kinds of provisions. Josh, do you have a sense?
Yeah, so generally speaking, most funds have wide discretionary powers when they want to invest pretty much anywhere that the U.S. government would allow them to invest. So, removing Cuba and North Korea and Iran and places like that, you pretty much can invest anywhere. There are a lot of funds, however, that simply don't invest outside the United States as a matter of strategy, not as a matter of legality. So they may have just raised their fund saying to their investors, look, we're only going to invest in Silicon Valley companies. or we're only going to invest in New York companies, meaning companies based in those areas, not the actual legal documentation of the companies. Most of the well-established VCs, Sequoia, Andreessen, Union Square Ventures, ourselves, and a bunch of others, really can invest anywhere, and it's actually much more prevalent now to have some capital deployed outside the United States because there is a lot of opportunity there. The thing is, though, is that even when that money is going outside the U.S., it's still usually going into some sort of Delaware C subsidiary at the very least, simply because it's just there are rules in Delaware that make it desirable to have your company based there. But you know, you rarely will find a well-known VC that's precluded from investing outside the United States by law or even by the legalities of the documents. It's really just about their style. But you can find that out also very easily so that you don't waste your time with them either.
Yes, and Josh, that plays very well into actually this next slide and the next point, which is, well, you don't necessarily need to have a U.S. topco. It's certainly in our experience, we found that a U.S. operating subsidiary with a sort of significant U.S. commitment is generally a prerequisite in terms of getting U.S. investment, unless you have a U.S. VC who actually has an office in London or somewhere else and is investing through that office. There are one can point to exceptions to that at early stage, but at early stage we found that is very prevalent. Once you get to sort of a B or C round, I think there is more involvement of U.S. Venture capitalists who are in fact going into rounds in non-U.S. companies, but they're really relying on the lead of a local VC in a rather more developed business. So what we have found really is that the key need is really to have a founder or senior officer on the ground and located in some proximity to the potential investors. And what proximity means varies. I mean, we certainly, in terms of talking to venture capitalists in the Silicon Valley, you know, proximity may mean, you know, within 15 miles of San Francisco. I think on the East Coast, maybe there is a bit broader view of what proximity means. But the implications of that are sometimes, first of all, that you may need to set up in the U.S. at an earlier stage than you would for operational reasons if you're finding that there's a funding gap in your home market. I mean, in the UK, for example, it's not that difficult to get, say, 350,000 or 400,000 pounds sterling of seed investment for a good investment for a good company. But then there is a pretty difficult, a high level of difficulty in terms of going from that level up to about 3 million sterling or 4 million sterling. And so we have companies which are going to the U.S. earlier than they would otherwise in order to try to locate near to where they think the U.S. investor may be. And so as a result, your locational decision isn't just a decision about where your customers are going to be or where your suppliers are going to be, but also where your potential investors are. There's another side effect of that, which is sort of noted on this slide, which is when companies are going to the U.S. at an early stage, obviously they don't have a lot of money. And so one of the key issues is how to establish on the ground in a cost-effective way and not incur a lot of expense. That's a lot easier to do now than it was, say, 5 or 10 years from now ago. There are folks like Early Growth and other kinds of outsourcing services, payroll, benefits, which make it a lot easier to do initial setup on a fairly cost-effective basis. And the real question, the real expense usually comes with people and the salaries that you have to either hire people locally or by sending them over from the home country. But it is important when you go in and you do U.S. setup that you get clear transparency about what things are going to cost. Your professionals at this stage ought to be prepared to give you fixed fees, and if they can't give you fixed fees, they should at least be able to give you transparency as to what things are going to cost with maybe caps, and they ought to be able to show you what their experience is in doing this on a routine basis. And none of this stuff is rocket science. You shouldn't have to pay for somebody to invent something that should be pretty routine. As I said, one of the decisions is really a locational decision based on investors. I just want to point out that there are many different investor communities in the United States. The Silicon Valley isn't the only choice. The Silicon Valley and New York are not the only choice. But each area has particular specialties based on the businesses in that area, where other key exits may have happened. So that in many cases, a lot of the early stage money may be coming from people who have successfully exited a business and are looking to then invest in another business in their area of expertise. But as this slide shows, for fintech or advertising or publishing, New York may be a sensible place. Biotech, Boston and Washington are good choices. Media, Los Angeles. Insurance could be New York or Chicago. Emerging markets, maybe Miami or New York. Tech, I've shown Seattle. You could also say Boston might be another choice here. And Austin is a market which is increasingly becoming of interest to companies moving to the U.S. I mean, Josh, do you have any thoughts on this more generally?
So, I mean, there are definite advantages to going to a specific market for capital. So, if you're in biotech, yes, you want to be in Boston, Washington, even North Carolina, not necessarily New York at all. There is some San Francisco-based stuff that happens there as well. Fintech is definitely very New York, as is ad tech and media. LA does have some media stuff, but in general, yeah, you definitely need to know your market, and you need to know where your strongest support is. So if your customers are based somewhere, you actually want to be there as well. So don't think that you have to be in San Francisco or you have to be in New York if your customer base is in Texas or even in Miami. It's okay to be in lots of other areas, and you might find that if you're a great company and you have a great opportunity for investment that the market sees, it might even be easier for you to get money in secondary markets than in the first markets. The caveat to that is once you're talking about getting big rounds of capital, you really do need to be in New York or San Francisco in order to do that, except for biotech, which is really at Boston. There are a few outliers in there, but generally speaking, those are the cities that you're going to have to eventually go to get capital.
Okay, I recognize we're sort of running close to time here, and so I'll go fairly quickly through these remaining points. U.S. Series A rounds tend to be significantly larger than elsewhere, so effectively one is still in the U.S. talking about seed investment until you reach sort of the $3 to $5 million range, and so you need to keep that in mind. Part of it is because the transaction costs associated with Series A and sorting out the rights of the preferred shareholders involves some expense. What people do in the U.S., and Josh has referred to this already, is they use convertible debt, which effectively will convert into preferred at the time of the Series A round. There are a number of issues that you'll need to think about in terms of that. Interest rate is one. Size of the round that triggers conversion is important. Price discount on the first round, typically 10 to 20%. So effectively, the convert debt will convert into preferred at a discount in price, which is 10 to 20% off of what the convert Series A is going out at. Quite frequently, there is a cap on the conversion price that it can't be above a certain level. And from an investor perspective, you should understand that investors have less control in the context of convertible debt. They don't have the rights that they would be getting in a Series A preferred. If you're doing non-U.S. Series A, you need to think about what changes may be required later if you expect to secure financing in the U.S. It is possible to do rounds, and we have done rounds where non-U.S. investors and U.S. investors are coming in at the same time, and sometimes one is having to address different tax and other issues, and it's usually possible to do that. But you just need to have some foresight in thinking about how you're going to get what's going to be required at the next stage of investment, and just make sure that you don't do anything at this stage which is going to make it difficult to get the next stage. Finally, just keep in mind that there are other sources of early stage financing besides the U.S. sources that we've been talking about. In the UK, there are various significant tax incentives with programs called SEIS and EIS, which only require permanent establishment in the UK. They don't require that you actually have an English company at the top. There are other markets which are similarly trying to encourage early stage companies, especially tech companies. So you should investigate those sources of funding. And I think a final point I would like to make is a lot of what we've been talking about today has been focused on sort of the special issues of non-U.S. companies coming into the U.S. But in terms of preparing for investment, don't forget the kind of basic stuff that you need to do to prepare for investor due diligence. You need to make sure that you have inventoried your IP, that you own it all, that if you've used open source software, that you're in compliance with its terms, that you clean up your capital structure, and just generally do the stuff that's required to, so that when investors come in and do due diligence, they will like what they see and not walk away because of problems. Finally, we've done a book which is focused on some of the legal and tax issues associated with setting U.S. Operations. It's available as an e-reader or as a PDF, and the details are on this slide. So thank you very much.
Wonderful. Thank you so much. And I'm sorry that we've gone a couple of minutes over here. So we'll end now. We will be sending out this deck to everyone on the recording, so you'll be able to review that. And you see contact information here. So if you have any follow-up questions, feel free to reach out to our presenters. I also have a few outstanding questions we didn't have time to get to, but I will address those individually via email so that your questions have been answered. We have another webinar tomorrow on lean cash flow, simple steps to better startup cash management. If you're interested in that, just go to our website, our events page, and you can sign up for that or check out other upcoming events. So thanks again to Bob and Joshua and Glenn for a fantastic presentation, and thanks to all of you for your time. Have a great day.